Hey, how's it going, guys? Welcome back to mentfx. This is episode 6 of the entire masterclass, and there was no better time to do this, especially after catching this trade right here, that we can get on to the next topic of inefficiency and of liquidity. So thus far, we have looked at about a 1 hour top-down analysis of liquidity and how we can spot in the market and why it's important in terms of where orders lie. And we've started to understand how order blocks form off of big moves up to grab liquidity before coming significantly lower to come and retest them in the form of mitigation before dropping even lower. And now today we are going to touch on the idea of imbalance, how it is created, why it is created, how it gets filled, and then how price moves from imbalance to imbalance, and oftentimes how it might leave some to come back later. So this is ultimately going to add to your arsenal right now of inefficiency and liquidity concepts, okay? So an interesting comment that was left on one of my videos was a question about imbalance and effigies and voids and inefficiency and the difference between them all, okay? And the way I answered that was by saying that not all inefficiencies are imbalances, but all imbalances are inefficiencies, okay? And now the interesting thing is imbalances, fair value gaps, effigies, voids are ultimately part of the same thing, just about how you've learned it and how it has been taught to you. Okay, so before we get into any of this, and the reason this is a perfect example of what happened is because we were able to catch this sell on gold just a few days ago on the 28th, so actually yesterday, in this very, very consolidated market that ultimately looked like it was not doing anything. Yet we were still able to catch a 1 to 17 and now looking to catch a 1 to 5 potentially. So we saw this come down to that perfect area as we were anticipating in our other videos. Not only this, but we also caught this right here, which was also based on some of those ideas, which we'll look at today concerning inefficiency. And if you all remember, we looked at Euro Yen a few days ago, anticipating up movement from here. We got about 1 to 1 before this drop that came down perfectly to this area we were looking at earlier, and we're going to be looking for buys in and around this area to come back, potentially up here or just up here on a very short time frame. So of course, why risk management is very important. When we got into this right here, we actually did take 1 to 1 and then we got stopped out, so we actually did make just a tad bit of profit on this trade despite it going against us. Okay, so to start, we're going to discuss what an imbalance is and how we can spot it in the market. Okay, so let's imagine back to our older teachings. If you haven't been there, then this will be a quick recap. We have a market that maybe begins to consolidate, that huge move up, maybe a huge move down. I should just make it like this. So we have a market that's consolidating, this huge move down that makes people start to sell, huge move up, usually fueled by a lot of buying on the side of big banks or smart money like this, trapping many people up here as they start to buy this breakout and then try to buy this retest right here. And as they do that, banks drop this right back down, maybe continue it significantly lower. Okay, when they do this, of course, we recognize that there's most likely an order block being created in or around this area, right? So let's just write that in. So we have most likely an order block in around that area. Price begins to fluctuate in or around this area, right? Maybe it goes even lower. And what we'll notice a lot of the time is within areas right here, so we're going to denote these in purple, there are what we like to call imbalances being formed, okay? And sometimes these do happen under order blocks, and we'll discuss why this happens in just a moment. So this is an imbalance, okay? And now what we're going to do is we're going to take this area right here and create a little snapshot of it right here, okay? So what happened is after we, let's say, had this huge move up in the form of this, in that green candle, so this would be that green candle up, right? So we're just moving this price over here, just taking a look at it in form of candles, and a huge move down potentially, right? And let's keep in mind that all of these have most likely what? Wicks. So let's draw these wicks in, because the wicks are what's the most are one of the most important things when it comes to looking at imbalance. Okay, then we potentially, you know, have this small move up, maybe to test a little bit of that order block prior. Something like this, and then we have this continuation significantly lower, right? Maybe we have this continuation significantly lower, maybe a small, just a small one, just like that, and then that continuation even lower, okay? And as this happens, of course, we have to keep in mind that a lot of these have wicks back and forth, back and forth, back and forth, okay? So these are all wicks. So now let's take a look at this purple area, and I denoted that as an area of potential imbalance, okay? How do we spot imbalance? Well, the imbalance is the connection between two wicks that have a body candle separating them, ultimately. So the way you want to think about it at first is to count 3 candles, really, from anywhere. So if this was candle 1, this was candle 2, and this was candle 3, you'd want to denote this wick. So if you just draw a line across, and then this wick on the third candle, so the first and third candle, this area right here would then become an area of imbalance, just like that, okay? So the idea here, and why this forms and what the purpose of this is that once the smart money or the composite man or whoever it is that got involved in this market at this order block right here, bought into this market extremely heavily and then sold off, they mitigated just a little bit. But when that sell-off happened, there was no demand or supply left in the market. So that's why the market moved so quickly, okay? And when the market moves extremely quickly, what happens is we don't offer the market on both sides, so that means buy side and sell side, to every single participant in the market fairly, okay? So that's where the whole notion of a fair value gap comes from. The idea is this gap that was formed because of non-fair value. So the assumption is that later price will come to revisit this area before dropping again, right? Or doing something of that sort, because it needs to fill this price in for efficiency. So the people that weren't able to be in this market can now come back into it, okay? And as a lot of you might know, there are multiple terms, like I said, that are used for this: imbalances, effigies, sell side inefficiency, buy side inefficiencies. In this case, this would be a buy side inefficiency or sell side inefficiency. I don't actually know how to use these terms because we don't use them that much. But the idea is the inefficiency is created because there wasn't enough buy side offered within this area. So that means all the buyers that were potentially looking to be present here were not able to get involved, hence the wick not filling, right? So what you'll notice in a lot of markets is oftentimes when they move, these wicks will actually sometimes come and just connect from wick to wick, right? This thereby filling in this whole area during that time that this happened for fair value, right? So just by looking at this example on its own, where else can you right now spot imbalance, right? So this is something else that's interesting. The third candle doesn't have to be formed for there to count as an area of inefficiency, right? So for instance, if this was candle 1, this was 2, and we have this figurative third one, well, we know that this third one is technically started right here. And if it doesn't move up, what does this entire area right here now become, right? So this area right here now becomes an area of inefficiency or an area of imbalance with what, so what mindset should we now have towards this market is that eventually when it starts to finally begin to come higher, it's going to come to fill in all these areas right here, which means this imbalance too, before doing what? Potentially, mitigating more of this order block and then coming significantly lower. Okay, and that's exactly what we saw happen on gold. So if you notice very quickly, we came up to create this order block as we were looking at that filled in this inefficiency right here. So you can notice this wick to wick just right here, filled in that, filled in more than half of it, filled in this entire one right here. As you can see, wick to wick, filled in that, dropped off, creating, as you'll notice right now, this little area of inefficiency right here that came to get filled. And then guess what price did? Finally dropped off from those order blocks and those important areas, especially with the redistribution that we had noted down right here. So what we're going to do is we're going to go back in time and just try to print some candles to talk about how imbalance is created and how it is filled over time. The interesting thing about imbalance is that you cannot just specifically trade imbalance looking for it to get filled and then seeing a rejection from that area. Okay, because oftentimes what an imbalance will do is it will act as an area for the creation of more liquidity in the form of swing highs or swing lows to then continue either higher or in some cases, if this is on a higher time frame or something like that, we could come to fill it and then go much lower before coming to fill the rest. So looking to create just a trading strategy off trading imbalances alone will not work because these are not, unless there's something else that's important within it. Like for instance, if price when it was coming, when it was consolidating within this area right here, had maybe a move down before that huge move up. So that's this consolidation that we're talking about with that move up into this order block. Well, then this area right here becomes what? A mitigation block, which we'll talk about later. So when we come to fill about half of this fair value gap or imbalance or whatever it is you want to call it, we're also filling in this mitigation. And once we do that, that's enough reason, that's a catalyst enough to go significantly lower or to another area in the market, right? And as we've spoken about, or we will speak about in a future video, price likes to move from liquidity to liquidity. Liquidity is where price wants to move. Liquidity exists in the form of orders that are resting in the market, right? But it also, because of that, exists at areas of inefficiency, which are known as, in this case, what you've learned thus far, order blocks and imbalances. So now that we've taken a look at what this looks like and we understand that an imbalance is caused by a wick to wick movement from between 3 candles. So in this case, if I asked you where was the imbalance in all of these candles, where would it be right now, right? So it would be from this wick to this wick. So we have this area of imbalance right here. And it would also right now be from this figurative wick that we have here to this right here, right? Because this third candle technically will open here. So this area will exist as an area of inefficiency as well, or as we like to call it, imbalance, okay? And we're going to go and take a look at this in the live markets right now. So we're gonna take a look at it in gold in terms of why we were able to catch this in terms of inefficiency. But before we do that, we're just gonna look at inefficiency in general on a daily perspective of the market. And we're just going to start right about here. Because it'll help us frame the setups for the future, okay? So right now, if I was to ask you, where's all the imbalance you see, just from this area right here to this area right here, right? Where would you be able to draw all these areas in? Those that are very apparent to you right now, right? So pause it or don't, we're just gonna do that right now, okay? So we're gonna denote them with just a box, and we're gonna go from wick to wick. So if we start here, we see this wick to wick. So this right here is a very small imbalance, right? We could consider that, but right now we won't. Let's take a look at the bigger ones. So this wick to wick is actually a bigger imbalance. And just like that, we have this wick to wick, which is an imbalance as well. And you'll see that this one right here is also an imbalance, right? So what we can expect is that these areas are eventually going to be filled. Okay, and the reason this is important is because in the future, when you're looking at certain things and you're looking at structure in the market and you're looking at order blocks being formed, mitigations being formed, oftentimes you can decide or convey to yourself the directional bias of the market and where it wants to go based on the areas it wants to fill. So despite the market climbing significantly higher here, we know that the creation of all these areas here is ultimately setting a precedent for the market to want to do what? Come lower to potentially fill all of these areas eventually, right? Okay, so what we're going to do is we can denote just one more, right? So like I said, it doesn't have to always be the 3 candles. It can be from a wick to the newly formed candle, which has not formed yet. So if we think about it, the open of this candle will be here. So this itself is an imbalance. And now we can take a look at what happens. So the market fills just about a little bit of it before continuing higher, creating what? A new imbalance right there. So this right here is also now considered an imbalance. So what can, if we believe the market wants to go higher, we could see this get filled and a continuation higher, or we can see this get filled and that continuation higher. We don't know yet. So we see a tiny fill of this. There we go. And we see the fill of this imbalance having a little movement away. Why? Because what we're doing is we're using the imbalance to not only create liquidity, making people think this is going to continue higher, but also to fill in prices where price was not offered fairly. Okay, so let's continue watching this, seeing what imbalance actually does. Okay, so you see how we come through and clear all this imbalance. But as we clear the imbalance that lies in here, notice what we've created. We've created this wick to this wick area of imbalance. So now what we have is we can already set precedents or ideas about where this market wants to go based on the fact that we understand this needs to be filled and this needs to be filled, right? So we could see maybe a move to about halfway here before this continuation lower to fill all these areas of imbalance, okay? Now, this brings me to the next important point, and you should be taking notes on this right now, but the reason price will sometimes respect half of a imbalance or a fair value gap or whatever it is that you have used in your smart money ways, or if you're new to it, just call it an imbalance or an inefficiency. The reason it comes sometimes to just half before continuing in a certain direction is because if you consider price in its fractal nature, within this area of imbalance, there's most likely some kind of order block here. And what you'll notice is on a lower time frame, this area right here actually will act as a mitigation. So what happens is if we jump down just a little bit lower, you'll start to notice that in essence, this area, this huge area that was an imbalance, actually has an imbalance that lies right here about halfway. And also what's funny is that lies right on this mitigation block right here, as you'll notice, right? We'll talk about mitigations later, but that would be the reason that price would want to come up and fill just about half of it before dropping. So the important parts of imbalance, when you're looking at it from an institutional perspective, is the entire fill and about 50% of the fill. And what you'll often see is you'll see movement or rejection of price in some way or another from those areas. And you can now answer the question as to why that happens. And it's because price is acting at those areas to either create liquidity for the future that can be taken out, or to mitigate orders before taking it lower, to then create more orders to go higher before coming even lower. Okay? So what we're going to do is we're going to jump back on the daily because we're just talking about the idea of these imbalances right now. That area we drew was, I believe, right about here. So we'll just keep this area in mind and see what happens. Okay? So price actually does wick down, taking out this imbalance right here. You see how it comes down just to fill this and then rejects, coming up to about a quarter of this. Price comes up and hits half of it, giving us a small rejection. Doing what? Most likely creating some kind of liquidity. Let's see what happens next. So now we're coming lower, creating that potential trend line on a lower time frame, and then we break through. So notice how, despite just coming to half, we didn't just reject all the way down to here. But what we did is we filled in some of this. Now what can we expect? Well, now we can expect that more of this needs to be filled before we start coming down to these areas, right? So we come and fill the rest of that imbalance, or a good proportion of it. What you have to notice is sometimes these wicks are very important too. This was the entire imbalance area, but this can count as filled, okay? So what we're going to expect next is most likely some kind of move down to start filling in the imbalance here. And now what you'll notice is on this move up, we've created this wick to wick imbalance. Okay, so what happens is we now want to fill this as well. So we'd be expecting lower prices until we at least come to fill this, small move up, continuation down, right? And we can come into those areas of imbalance to fill them. So let's see what happens. So we come right through, filling that imbalance. And what do you notice we create as we do that, right? We now create this new area right here. So this would be our area of interest when we're just talking about imbalance-wise. And as you can start seeing, comes to about halfway, fills in just a little bit more of it, fills in a little bit more of it, fills in the whole thing, hits the order block and drops, right? So now you're starting to see how you can just use imbalance to start predicting the directional bias of the market. But now what we're doing is when we start applying that on top of order blocks and things like that, which we are going to do in the next episode, we start to create kind of an unbeatable strategy in looking at the market from top down. Okay, so what we've done is as we've hit this order block and we've traded down from it, we've created what? This new area of imbalance right here. Expecting what? Most likely this move up into it with a continuation down, right? So we have a move up to about half of it, continuation down, come up to about half of it, fill in the entire imbalance. So on a lower time frame, what would we be looking for at this point? Well, potentially lower prices, right? So let's take a look at what happens. We get a little bit lower, come up a little bit higher to fill in more of this imbalance and hit this order block. So what can we expect next? That continuation down. Now, as we continue lower here, we have to keep in mind that these areas are still areas of imbalance that have not been filled yet, right? So price wants to make its way down here. But to do that, it needs to fill in important areas on the other side as well. So what are we creating when we go from here to here? Well, this is a new area of imbalance, right? So price comes and fills just a little bit of that and actually just drops straight down into these areas, okay? Creating this area of imbalance and now creating this area right here. Okay, so we filled about halfway of this. So what can we expect? Potentially price just wants to come up to half of this before dropping. And how can you see that half of this is important? Well, now we're hitting this wick right here, right? So let's take a look what happens. We come up to about halfway, a little bit less. Come up to halfway. Play in around this area, filling in this area and wicking this imbalance right here. Okay, see what happens next. Coming up to fill more of that imbalance, filling about half of it, rejecting, creating an imbalance right here, right? Notice how this is now an imbalance technically, right here. Fill that quite rapidly. Continue much higher, filling in what? About 50% of this imbalance. Having some rejection because of that. Creating more liquidity, creating what? Now. So notice how we now, as we moved up to this area of imbalance that we had right here, about 50% of it, we also created this area of imbalance right here, which just got filled. But because of this fill, we've now created this new area of imbalance right here, okay? So we come and fill that. We reject around it for a little bit because why? We're filling in price at all these areas and we're letting it fill in the entirety of that. And then we continue and we're right here now. So after filling all this imbalance, we're continuing lower, creating all this imbalance, coming to fill what? The imbalance down here and also targeting equal lows on a lower time frame and all this other stuff, okay? So that brings me to our next talking point, which was how we were able to understand this was most likely going down, right? So what happened is when this market was first coming together, what you'll notice is we'll replay from just about right here, okay? So at this point right here, we have this point of imbalance right here, from here to here. You're noticing that about half of it is being filled, almost 100% of it is filled. We do also, don't get me wrong, have this imbalance here. Like I said, not all imbalance is always going to be filled. Eventually it will be, but it does not have to be instant. So this imbalance might not be filled for years even, if gold wants to continue significantly lower, okay? So price comes and fills the entirety of this imbalance right here. And when it does that, what you'll notice from our other concepts is it's taking out all the highs that exist here, using all these orders that lay here in terms of stop losses and buy stops to collect orders to take them further down. So once smart money or whoever is interested in this market got involved right here, and then it starts taking the price significantly lower, what have we done when we've done this? We've created an imbalance in this entire area right here. See, so notice that we filled this imbalance by creating this order block, continue lower, creating this imbalance, expecting what most likely for price to eventually want to fill that, right? So we continue lower, filling about half of it, leaving the imbalance from this wick to this wick, right? Now we have this imbalance, and what you'll also notice is we also have this imbalance right here. Right, so notice that. So if we understand, which we did at the time, and we were looking for lower prices on gold, where could we now begin to look at lower prices from gold from? Well, we'd want to see the fill of this imbalance before that continuation significantly lower, right? Hence this setup right here, which was also based on a order block, not just the imbalance, which is why understanding imbalances is very important. So we come fill about half of it, leaving just this area right here, right? Filling in the entirety of that. And now what will you notice? As we filled this, we've created this wick to wick movement right here of imbalance, right? So what can we expect? This is going to come down to fill and then continue higher. So we come down, we come to fill it, we come to fill it again, and we come even lower. Fantastic. So as we've done that, we still have this area of imbalance that we are looking at. We've created this new area right here of imbalance, okay? Come to fill almost all of it up, leaving this area of imbalance right here only. Come to fill a little bit more of it, fill the entirety of it, play in and around this area for a while, filling in price, continuing lower but coming back up. What's happening at areas like this? Many people are starting to see potentially a trend line here. People are starting to get involved in sells. People are looking not to miss the move here as it starts to drop heavily. They start seeing this uncertainty in the market and a lack of bullish pressure. So everyone's trying to get into sells here. And as we start going, we then take off to the top side. Now, where's the only imbalance that you can now notice, right? So we still have this imbalance, which we are anticipating to be filled in the long term. But where's the short-term imbalance that has just formed? Well, it's right here between these two, right? So we can most likely expect that if price wants to make its way back up here, it can come and trade off these areas. And these are opportunities for times where you can get in, okay? So we fill that in, and we come higher. Okay, so now our new area of imbalance would now exist within this wick to this wick. So around this. So we can expect that to get filled real quickly. There we go. Before that continuation higher. And then we can continue with this all the way up, right? So this is an area of imbalance too. There you go. We have it filled just now. We have that move down. So where's our new area of imbalance now? Well, it's actually from here to here. And now we have this small area that needs to be filled for efficiency. So we come and fill that very quickly, continuing higher, filling in what? About 50% of this, where we reject for a little bit to create what on the other side? Liquidity before we come to fill the rest of it higher up. There we go. And as we come to fill this this area of imbalance or liquidity, what do you notice happens? Well, we start to create these areas right here. So this becomes an area of imbalance, and so does this area right here. So we can expect those to be hit, right? So let's take a look at what happens. So price comes up and forms equal highs. This is why we had this notated here, and we were also looking at a redistribution in the form of Wyckoff. So we were actually looking for sells at this point, but we were expecting price to come a little bit higher to grab the orders off this and end up hitting higher areas of this order block right here. okay? So what happens is price drops right down, filling in all of this imbalance, but doing what as it does that? Creating this bit of imbalance right here. So we can expect that price wants to still fill that before going significantly lower. Again, it starts dropping much harder. People are starting to get into this FOMO'd in. This is why you never want to be FOMO'd in. You want to have an actual system that makes sense to you to be trading. So these are 2 areas of imbalance now, looking for price to come higher to fill those in. So price comes to fill some of those areas, rejecting at about halfway on lower time frames, right? There's potentials for entries there. And as we continue higher, we come and take out those highs, and then we drop off from there. Now, as we drop off, we have created ultimately an order block here, so we can look to trade off that. But also, we now have created this imbalance here, right? So we can just look for the potential for either sells right here with the stop loss here, or if we understand the idea of order blocks and how price wants to move, we can look for sells up here at these order blocks, knowing that price is going to come to fill some of this imbalance, right? So price comes up, fills half of it, fills all of the imbalance, creating some imbalance where right here now, as you can see, comes even higher, almost hitting this this entry order block. Hits that entry of the order block, and what does it do as it does that? Well, it also now creates this small area right here that we've been looking at over and over again, expecting now for price to want to come and fill this potentially, and then drop all the way through to where? Well, the areas that we had signified earlier. And something interesting about some of these areas here is what we'll notice in a second. So after we come to fill this area right here, also breaking out of this creek of our Wyckoff distribution, we can be expecting lower prices. Now, what's interesting is, let's say you missed this trade right here. What you'll notice now is that as we start moving down, we're creating these areas of imbalance right here. So we can now be looking for re-entries based on the idea of imbalance in these areas right here, just like this, right? So what happens is we come and fill that perfectly, as you can see, before continuing lower, creating more imbalance. We don't always have to fill imbalance, remember that. And then we begin to drop off quite rapidly as we filled in all this area. But what you'll notice is the reason we were able to understand that this market most likely wanted to go lower, even though it was in somewhat of a consolidation, was because we started to put together a lot of our paradigms of liquidity and inefficiency in the form of, if you look at how price moved here, when we did look at it on the replay tool, you'll notice that at no point was there any liquidity or imbalance left in the market. Notice how there's no imbalance here at all that's not been filled. Everything's been filled. The only area of imbalance that hasn't been filled was right here, right? Which actually got filled right here, creating those equal highs, giving us an opportunity to start to get in. Maybe we do get in here and we get unlucky. And then as we create this movement right here with the breaks of structure on the other, and our creation of the order blocks, we are able to get in, and if we aren't, we're able to spot this area right here with imbalance. So imbalance will help you notice where the inefficiencies in the market lie. So once we get there, you can expect something to occur. And now the cool thing is when you partner that with something like an order block, and you start to have like this idea right here. So if we go on a 30-minute right now, yeah, what you'll notice is when you start to partner things like an order block, this up move through all these highs to collect all the orders, this continuation down, trapping all the people up here. And then when we come to mitigate that, when there's also an imbalance here, you have a higher chance of expecting a downturn in the market. And then you're able to catch things like this, right? Now, while we, of course, we didn't just have this preset like this, looking for significantly lower prices and just holding this 1 to 20. We, of course, took profits at 1 to 6, and then we wanted to take them significantly lower. As the market moved down, we had this area right here as our first term goal, and you see how that moved away from it, and now we're just in this area. So what you'll notice is if we just draw a line right here, from here all the way across, what's interesting is you'll notice price stopped at, if we just draw this across, so you'll notice price stopped at another order block, but what you'll also notice is it was coming down to fill all this area right here, right? The small imbalance. So this imbalance hasn't been touched since the 20th of September. This is only a 30-minute chart, but it came and gave us a reaction from there. Why? Well, because it just filled it in for fair value. So it just filled the imbalance, and it might be creating more what? Liquidity to go even lower, right? And to do that, we can be looking at certain areas. That's why I have this in right here. We're looking at what? For price to come to fill in more imbalance on the top side, like this, grabbing orders on the top side, hitting potential mitigation blocks, whatever it might be called, whatever you've been learning it as, before we come even lower, coming to take even more important lows here, and of course grabbing equal lows to take market potentially higher. So that's what we were looking at on gold, and that's how imbalance is used to calculate directional bias in the market. So what's funny is we also looked at GBP/JPY, and we're going to be looking over this in the next video into how we potentially got into all this. But what you'll notice is when the market came and created this order block right here, when it grabbed the highs here and here, coming significantly lower, what you'll notice is we left all these areas of inefficiency right here, from here to here, here to here, just like that. So when we came down, we were anticipating price to want to come back up here. Why? Well, for one reason, they want to mitigate this order block, and for the second reason, they want to fill in for fair price at these imbalances, because imbalances like to get traded to before being traded away from. So what you'll notice is price came up, traded into this first imbalance, had some rejection, traded into the second imbalance, also hitting our order block, before then continuing where? Significantly lower. What did it do when it came into around this area? We created that order block before that continuation significantly lower, creating what? Fast price movement. So when fast price movement happens, what happens? There's inefficiency created in the market in the form of, in this case, an imbalance and an order block. When we make our way up there, we're making it up. Look how slowly we make our way back up there, doing what? Filling in all these areas of imbalance. As you can see, there's no imbalance left. All these wick to wicks have been filled by the price movement. So by the time it gets back up here, filling in this entire area right here and mitigating off this order block, we have this strong drop off. Okay, so that's how you use imbalances to spot areas in the market where you can be interested in being a seller or a buyer, and coupling that with all the other things you've been learning thus far can help you create some very profound directional bias ideas and ultimately aid you in your trading. So in the next episode, we're going to try and put some of these put some of these things together in the form of how we caught this trade right here. And right now, all you should do is go into your own chart right now and look at some areas of imbalance as price moves and notice how it is filled over time. So you can literally go to any time frame, any place. You'll notice that this happens anywhere and everywhere, and start looking for areas of imbalance. So for instance, this wick to this wick, if you draw it across, you'll see it actually got filled. This wick to this wick, same stuff happening, right? It's all moving up to get filled. As price is moving, it's creating all these wicks that are being filled. Huge move up in the form of what? Most likely an order block, continuation down. Look at this. No imbalance, no imbalance, no imbalance until right here, right? You see that? And that continuation lower. Now you know this order block was filled in and mitigated multiple times. So when price comes back up to this order block right here and this imbalance right here, you can be a seller, right? And you can be a seller for short term as it comes down, and then it comes higher, hitting this order block, mitigating off it. To do what? To come fill some more inefficiency on the other side before coming even higher. Creating imbalance, filling it, creating imbalance, filling it. And you can see this happen on any time frame, right? So if we just jump down to, for instance, a 1 minute time frame and take a quick look at how price likes to move in terms of imbalances, you'll notice that a very similar thing happens. So let's just take a look at this area here. So this was an area of imbalance. Price began to move away from it. Right? As price started to move away from it, it started creating its own imbalance, filling that imbalance, imbalance here, filling that imbalance, imbalance here, filling that imbalance, coming down to fill this last area of imbalance before taking off and going significantly higher. Okay? So this is how you can now start to couple imbalance with the ideas of order blocks. And the cool thing about being able to do something like this is that now, as you start to look at any market, any commodity, any indice, and you start noticing areas like this, and you start noticing price movements that are somewhat dynamic and very unpredictable, you'll be able to explain the reason for a lot of price movements. Because now, if you just put together the ideas of order blocks and imbalances, you can very clearly explain away a lot of the idea about why price moves the way it does with the weird wicks that it makes and the weird patterns that it makes. And then you start to move away from the whole notion of trading actual candlestick patterns and support and resistance, and you start understanding the reason for some wick movements that, you know, this wick movement looks very just weird, and it looks like it might have just taken out some people that were selling here. But in reality, this wick movement was made to fill in this last bit of imbalance here, which was ultimately also a mini order block that got hit, that got traded away from, that was used to catapult price into this imbalance that we looked at right here, creating what? A mini order block that got traded from, traded off, creating this imbalance, which got traded to about halfway before taking off, creating what? This order block that got traded into, mitigated from, continuing higher with imbalances that were filled as price went up, right? And we had that continuation significantly higher. And as we look through each area of price, we can do it on this on a minute, on 5 minutes, we can do it on the 30 minutes, on the yearly, on the daily, on the monthly, it doesn't matter. The idea is price will consistently move in these ways. And once you start to notice that and your perspective starts to shift, you can start to actually predict movements and directional bias in the market and understand why you are winning or losing trades. Okay, so thank you for watching, guys. This is mentfx's episode 6 of the masterclass. Hopefully this made a lot of sense. If you have any questions, please leave them in the comments below. If you have any other suggestions, please leave them. If you like this video, leave a like. If you hated it, leave a dislike, but let me know why so I can improve it in the future. Anyway, thank you so much for watching, guys. Till next time.